Ladies and gentlemen, good day and welcome to the Sudarshan Chemical Industries Limited 4Q FY22 earnings conference call hosted by Ambit Capital Private Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kumar Saumya from Ambit Capital. Thank you, and over to you, sir.
Thank you, Vivian. Good morning, everyone. Welcome to the 4Q and FY22 earning call of Sudarshan Chemical Industries. From the management side, we have Mr. Rajesh Rathi, Managing Director, Mr. Neelkanth Natu, CFO, Mr. Vivek Thakur, GM Finance, Mr. Amay Atle, DGM Finance, and Mr. Mandar Velankar, Company Secretary. We will hand over the call to Mr. Nathu, sir, for the opening remarks, and then which will be followed by Q&A session. Over to you, sir. Thank you.
Thank you, Kumar, and Ambit Capital for hosting our earning call. Good morning, ladies and gentlemen. Welcome to Sudarshan's Quarter 4 and Annual Earning Conference Call. Our investor presentation has been uploaded on the stock exchanges for your ready reference. I would like to take you through the financial highlights for this quarter. On a consolidated basis, the total income from operations stood at rupees 627 crore as compared to rupees 577 crore for the same period last year, reporting a growth of 9% year-on-year. EBITDA for the quarter stood at rupees 86 crore as compared to rupees 87 crore in Q4 FY21 last year. EBITDA margin is at 13.7% as compared to 15.2% over the same period last year. Profit after tax is at rupees 45 crore compared to rupees 48 crore for the same period last year. For the fiscal year 21-22, the total income from operation is at rupees 2,201 crore versus 1,864 crore last financial year, a growth of 18%. EBITDA for the year under consideration is rupees 275 crore compared to 288 crore for the last fiscal year. EBITDA margin stood at 12.5% as compared to 15.4% for the last year. Profit after tax is at rupees 130 crore versus 140 crore last year. Now going into the details of our pigment business. For the quarter, income from operations stood at 558 crore, a growth of 5% year-on-year. EBITDA for the quarter stood at 76 crore as compared to rupees 84 crore in Q4 FY21. EBITDA margin is at 13.7% as compared to 15.8% over the same period last year. We saw softening of the demand and our focus to pass on further input cost increases has led to reduced sales. The domestic sales for the quarter is at rupees 287 crore compared to rupees 273 crore in the same period last year, a growth of 5%. Sales were lower compared to the Q3 FY22 owing to the modest demand impact from third wave of COVID-19. Sales in the coating and plastic segment continued to do well, while demand softening was seen in the ink segment. Exports for the quarter were at rupees 272 crore as compared to 60 crore, a growth of 5%. We continue to see stable demand across all the segments, including the improvement in the cosmetic segment in the international market. We continue to monitor the geopolitical situation for any potential impact, specifically in our sales in the Europe region. Specialty pigment sales stood at rupees 383 crore compared to rupees 363 crore for the previous year's same quarter, up by 5%. Non-specialty sales for the quarter stood at rupees 176 crore compared to rupees 170 crore for the same period last year, up by 3%. Gross margin for the quarter stood at 41% as compared to 42.9% for the same period last year. We see prices of the intermediate for specialty pigment continued at the elevated level, so at the stable status in comparison to the inflationary trend seen in the first 3 quarters of the financial year. We see further increases in some of the inputs going in non-specialty pigment. We are in the process of pass-through of these absolute cost increases during the current quarter. Apart from the raw material cost increases, we continue to see energy and logistics costs at an elevated level. Coal prices have gone up further and are about 300% of Q4 FY21 levels. This is pushing up the manufacturing cost. The challenges in the logistics area are continuing. Shortage of shipping container due to COVID situation in China and congestion at various ports is leading to delays in the shipping. This has also led to the freight cost escalation of 3 to 4 times. With the direct as well as the indirect material cost pressure lingering, we will have to continue with selling price increases, taking calibrated approach to balance on volume growth. On full year basis, the pigment sales stood at 2020 crore versus 1753 crore, which is a 50% growth. Gross margin for FY22 is at 43.1% compared to 43.4% during the last year. EBITDA for the financial year is at rupees 269 crore compared to 281 crore of the financial year 21. EBITDA margin is at 13.3% for the full financial year versus 16% for the last financial year. We achieved milestone in our domestic business with annual sales crossing rupees 1000 crore mark. Domestic revenue for FY22 is at rupees 1034 crore compared to 856 crore last year, a growth of 21%. Export sales is at rupees 985 crore compared to 897 crore, a growth of 10%. The specialty pigment sales for FY22 stood at 1378 crore versus 1203 crore in FY21, growth of 15%. Non-specialty pigment sales is at 642 crore versus 550 crore in FY21, a growth of 17%. Now coming to the Capex project, which is our thrust for the future growth. We are in the growth phase to implement the overall Capex of rupees 750 crore. Out of this, we have put to use the assets worth rupees 520 crore till the end of financial year 20. Balance rupees 2010 crore projects are a part of the capital work in progress put to use for this project has been pushed to a delay in some of the equipment deliveries. These projects are at advanced stage of completion and we expect to commercialize this by end of H1 FY23. About 70% of our Capex is put to use and started generating the revenue. For the new product Capex, we are getting good pull from the customers and these products are at the advanced stage of evaluation. However, for the Capex is made for the existing product line, demand environment is subdued. So, benefit from this Capex may be slightly delayed. We look forward to continuing our growth journey and delivering value to our stakeholders. With this now, we open the floor for questions and answer session. Thank you.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Participants who wish to ask a question may kindly press star 1 on your touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ankur Periwal from Axis Capital. Kindly proceed.
Yeah, hi sir. Thanks for the opportunity and congrats on good show on the margins front. So two questions there. Starting top down. So on the demand outlook side, you did mention there is some bit of macro slowdown, but given that our capacities are now getting commissioned over the next quarters or so, and we'll look to ramp it up. What are our thoughts on the export growth front? Where I'm coming from is if I look at the historical run rate, export growth has been relatively slower versus domestic, which has been doing reasonably well. So your comments there.
Thank you, Gurji. This is Rajesh. I think from our export growth perspective, a lot of our new products were targeted towards the exports, and I think we should see a good attraction on those area. Of course, given normal circumstances, we would have seen this faster and better growth, but given the current inflation, stagflation situation in some of the continents, we still, it may be delayed, but I think, the export still looks very promising. So.
Sure. And sir, just a clarification, if I got it right, now we are expecting the new plants to be commissioned by end of H1. Is that right? Which was earlier Q1 end.
So, sir, I think yes, somewhere between Q1 and H1 end. Yes, sir.
Okay, and it will take. We do have the product approvals in place, and hence the ramp up could be faster, or there could be some pushback, some delay in terms of ramping up as well.
I think ramping up should be faster. Ramping up would be good. We would try and speed up this, but I think so on the new products that should help a lot. On the existing product lines where we've expanded, there we are seeing not such a large volume growth where we are which we had anticipated, right? Because given the current external environment.
Okay, fair enough. Second bit on the margin front. Now, we did see some Q-on-Q improvement in terms of gross margin, while the growth in specialty, non-specialty has been largely okay. So is it the price inflation pass-through that we had done in the earlier quarter, which is visible now? And related to it, how much time do you believe it will take to effectively pass through the entire RM? And just one additional point here. You did mention energy, coal, logistics cost also increasing. So when we are taking a price hike, is the total cost under consideration and then you take a commensurate price hike? Or is it only RM inflation that we are passing through and the other costs are a hit on our P&L?
So obviously the objective is to look at the total cost pass-through, right? Total cost pass-through. However, you always have to balance out between, what you lose out and what volumes you gain. So I think that's the balance decision we have to take as a management. Right, and it's been a catch-up game, sir. Like we said, it's just the costs had not stopped increasing one after the other. So as and when we have been getting the cost increases, we have been passing on. We pass on, as I mentioned, the absolute increases and not the percentage increase, right? So that gap is there.
Sure. But sir, sitting today, just any timelines you can share, maybe over 1 quarter, 2 quarter, or probably more?
So, sir, I think as we speak, I think on the specialty part, I think most of our cost through has already happened. We've got in non-specialty areas, we've further got a cost increase, escalation, which we are in the process of passing.
Okay, that's helpful, sir. Thank you and all the best. I'll get back into the queue. Thanks.
Thank you, sir.
Thank you. Participants, if you wish to ask a question, kindly press star 1. The next question is from the line of Chetan G from Alf Accurate Advisors. Kindly proceed.
Hello.
Yes,
Hello.
sir. Kindly proceed.
Hi,
Thanks a lot for the opportunity, sir. Sir, couple of questions from my side. Number one is, what would be the volume growth for our specialty chemical business in this particular quarter and the non-specialty business?
Sir, in the context, we don't share this because our product range is so wide, right? So our product range, our price of our product range would vary between 70 rupees to 5,000 rupees. So it will just give a wrong impression on the volume growth, and that's why we don't give out volume growth. But to talk about directionally, sir, the products which we are focusing on are high performance, etc. We're seeing a good growth. On some of the other areas, on our classical pigments, we are seeing a little bit of a subdued demand.
Okay. Because what I understand here is that, sir, broadly, I mean, not specifically to your product, but if you see the basket of your kind of product, the pricing growth would be at least 20% odd, and our growth is 5%, on a year-over-year basis. So is it like there was a volume loss in this particular quarter? Hello?
As I mentioned, sir, in the high performance pigment areas, which we are focused on, there is a good volume growth. On the classical pigments, there are some challenges, sir, in volume.
Okay. So when you say good volume growth, meaning high double-digit kind of a growth?
Sir, high double-digit, your interpretation could be 99%, so I wouldn't want to comment from that perspective, but I think it's in the right direction, sir. Given the current condition of the market, etc., we are able to grow those lines.
Okay. And secondly, sir, if I can ask one more. Secondly, on the margin color, as you said that, in the classic pigment, you are yet to pass on the price. So should I see that, even the Q1 margin trajectory would be similar to Q4, even somewhat in the muted range?
Sir, I think what is happening is we are in the stage of passing on the increases, but we are not able to pass on two levels, whether the entire absolute increase, and then we are not passing on the percentage increases, right? So, there are, so from a trend perspective, I would say the trend would be slightly, I would say slightly better. We have few cost reduction initiatives, etc., which we are focusing on. But I wouldn't say there will be a substantial change, but the trend should be slightly better.
Oh, thank you, sir. Thanks a lot. I'll come back in. Yeah.
Thank you. To ask a question, kindly press star 1. The next question is from the line of Abhijit Akella from Kotak Securities. Kindly proceed.
Yeah. Good morning, gentlemen. Thanks for taking my questions. Sir, just on the Capex, just wanted to understand what share of the Capex has gone into the existing products, where you said that the demand environment is a little bit on the softer side.
Sir, could you repeat again the question?
Yeah. Sir, I was just referring to your comment that, the demand pull for the Capex that's been incurred on the existing products, that's a little bit on the softer side. So I was just hoping to understand how much Capex has actually been incurred on those product categories.
I don't have the number right hand. Either we'll come back to you with it. I just don't have it offhand right now. Yeah. We'll come back to you.
Sure. And the exact reason for the slowdown in these existing product categories, could you, just help us understand a little bit more about which end-use industries these might be that are, that have driven the slowdown? Is it autos or is it something else?
It's generally, we've seen a slowdown in printing ink, in plastics. Usually, if you look at geography-wise, right, we're seeing a lot of trends where Europe, North America is slowing down in these economies. So geography trend has been there. Printing inks has been difficult, and the plastic market has been difficult in the growth.
Understood, sir. No, that's helpful. And one last thing from my side, just on the margins have actually improved sequentially. compared to the December quarter quite smartly. And this is despite the fact that I guess crude oil rose, in the aftermath of the Russia-Ukraine crisis in February or March. So how exactly has the company managed to, improve margins? Is it by passing on the price increases? And then when we look forward into next quarter, the June quarter, should we expect some further impact of the escalation in crude oil prices, etc., on the next quarter's margins? Thank you.
Sir, I think what has happened is some of the pass-throughs we've been able to pass on the increases, and we've also been a little more hard on saying that unless we get the pass-throughs, we are not doing the sales. So we've lost some volumes on just the basis of that. We've not been able to get the increase.
I understand, sir. That's helpful. Yeah. So for next quarter, I mean, do you expect an intensification of input cost pressures, or have they largely peaked out already and they are not going to get any worse from here?
So I don't think it should get worse from here, but input price on the non-specialty areas is under pressure, is increasing, but we are passing that on.
Understood, sir. Thank you so much and wish you all the best.
Thank you, sir.
Thank you. The next question is from the line of Faisal Hawa from HJ Hawa. Kindly proceed.
Sir, in what areas are we doing our future R&D, and which are the areas where we feel that in 2-3 years we could be getting more revenue from, and which products just now are not developed, but probably in 2 to 3 years they could give us a good revenue?
There are two parts I would say to the question. I think one part is that as you're aware, several new molecules we've developed, and the R&D team is in the process of now commercializing it, right? So a lot of the bandwidth is going in the commercialization. The second new areas we are working are on pigments for digital inks. There are several developments going on. Also on the pigment preparation type, a lot of developments are in progress. There are several modifications on our high-performance pigments, improvement in the value of use that's going on. And the third pillar, I think, is looking at backward integration. So some of the important molecules so the team is working, we've developed our basic technology for those. Now we are seeing how to improve our cost position on those backward integration molecules.
We are not only working on cost for existing molecules, but for future pigments also we are doing R&D.
Yes, sir. Yes, sir. Like I said, the three areas, right? The three areas.
Would it be? I'm not asking you for a ballpark figure, but would it be a fair assumption that in 2 to 3 years, at least some new molecules would result in at least 20% extra revenue from new molecules itself, which are being developed, accredited, and ask for some approvals from the customers today?
Sir, as I said, a lot of new molecules are already getting commercialized, right? So our growth in the future is going to come from that. I wouldn't like to speculate a number, but I think a good growth would come from that. And I think the whole transformation story of Sudarshan was that, right? If we had continued with our existing portfolio, it would have been a very tough situation for us, and that's where I think the whole growth and margin improvements in the coming years should come through this.
Thanks a lot for answering my question so well.
Thank you, sir.
Thank you. Participants, if you wish to ask a question, please press star 1. The next question is from the line of Dhavan Shah from ICICI Securities. Kindly proceed.
Yeah, thanks for the opportunity, sir. So I have a question on the volumes part. So you mentioned that we have grown in terms of the volumes this quarter. But if I look at the capacity utilization for pigment, on quarter-on-quarter basis. So in Q3, the utilization was roughly 80 odd percent, and this quarter is roughly 76 odd percent. So is it so that the volumes have been declined by around 5% on quarter-on-quarter basis? Is this understanding correct?
So I think I would kind of paraphrase and answer in two ways. Firstly, I think as I mentioned earlier, sir, our high performance pigments and the areas of new areas, I think those products in the high performance and the good specialty products, we are seeing, especially high performance, we are seeing a good growth. And the classical pigments has been a little bit of a challenge. In terms of the capacity, your question on capacity utilization, we've put to use larger capacities now, right? That's where you see the capacity gap, utilization gaps.
Okay. So can you share the gross margin differentiation between, the high pigment and the lower pigment, the business mix between these two?
So from a competitive perspective, we don't share this information. Right.
And secondly, I just wanted to understand about the engineering business. So here we are doing roughly 10%, maybe around 200 crores kind of the revenue every year, but the EBITDA margin is roughly 3 to 5%. So what is the, the overall motive to continue this business? I mean, this little bit margin not accretive to the overall group. So, I mean, your thoughts on this?
Sir, the board is definitely deliberating on this, saying that how do we improve the EBITDA margins. You are absolutely right, sir. As it's currently a drag on the EBITDA margin, right? So I think the board is actively looking at saying that how do we improve the EBITDA margins. We've just concluded day before the meeting, and we're discussing with the management, saying that how does this margin need to improve? Yeah.
Okay, so we are not going to divulge this business as we have seen earlier for other businesses. This will continue, right?
Sorry, coming up. Can you repeat your question, sir?
Yeah. So we are not going to divulge this business as we have seen for other businesses in the past. So we'll continue with this business, correct? But we'll not improve the margin.
So currently, the board is deliberating on all options, but I think the first phase is to look at how do we improve our margin, right? Because as you rightly said, 3 to 5% of our EBITDA margin just doesn't make sense, right? So I think so. First focus is improve the EBITDA margins, and then look at it. Strategically, can we grow this business or should we divest?
Sure. Yeah, that's all from my side.
Thank you. The next question is from the line of Ashwini Agarwal from Ashmore Investment Management. Kindly proceed.
Hi, good morning, Rajesh and team. Sir, I had a broader question. If you just zoom out and look at the last 4 or 5 years, I mean, you've grown your market ranking on a global basis because of consolidation in the industry. There has been an opportunity to export from India in a lot of these businesses, especially relating to chemicals, engineering and chemical products where you excelled at, and you've invested in capacity, but the results have not been forthcoming. I mean, in either in terms of margin profile or in terms of asset turns. I appreciate that some of the Capex has been recently commercialized, so to that extent, maybe we are looking at a picture at a wrong point in time. But do you think that cap turns of 2.5% and ROC of at least 15-16% is realizable over the next 1 or 2 years after all the effort that has gone in, or market situation has changed and that's simply not possible anymore?
So, Rajesh, a very good question. I think, as you rightly said, sir, I think patience is the key main. Like, our whole, given the external environment of COVID, and the current whole geopolitical situation, right? The situation has been difficult, and that's where some of the delays have happened. Otherwise, we should have started firing from now on, right? But I think our fundamentals are right. None of the fundamentals are changed. None of the long-term strategies changed. So our growth delivery, our ROCE delivery would definitely happen. It's a matter of, it's just a delay, but it's not that there are any significant changes in the trend. It's just delayed.
Because, Rajesh, my concern is that, if you just simply look at the cash flows and over the last couple of years, your debt to EBITDA has now reached that 3 times number, which is, pretty much the line in sand where things can start to look a little hairy if something goes wrong. So, from here, unless we see revenue accelerating far ahead of capital employed acceleration, there's a difficult spot ahead of us. So I'm just hoping that the 1,500 crores of revenue potential that you speak about as a result of the capex that's already been put into the ground, including the 200 odd crores that's capital work in progress, that will be visible over the next 2 years. Otherwise, the debt coverage ratios, the return ratios, they will simply not improve. What do you think?
No, actually, no question about it. And like I said, whatever capexes we are putting up, we are having a good attraction. It's unfortunately COVID ho gaya in that time and everything got delayed, right? So that's the crunch you're saying. So probably we've already gone through the worst, right? And here onwards, I think we should be, and we've just completed our board meeting yesterday, and that's what we felt. I felt, sir, one thing is through this COVID and through these crises, it wasn't just handling the operations, but it was also delivering the capex. So the team has done well to deliver through COVID these capexes put to use, right? Now it's the time how we kind of, the difficult time is over. Now it's kind of turning this into good sales, and these are product lines which are well accepted by the customers. So I think that's where, Ashwini, we are very, we don't have a concern on delivering some of those areas of numbers in the next few years.
Okay. No, that's encouraging to hear. All the best. Thank you so much.
Thank you, Ashwini.
Thank you. Participants, if you wish to ask a question, please press star 1. The next question is from the line of Rajesh Kothari from AlfAccurate Advisors. Kindly proceed.
Thank you for providing the opportunity. Sir, I have a few questions, and it would be great if you can throw detailed color on that. First thing, I think what everybody is trying to figure out is that, while last 2-3 years were challenging due to one or other reasons, how the future, what is the story for us for future? And for doing that, we require, a little bit more, what I would say, concrete in terms of the building blocks, apart from capex, that what is happening from your customer perspective. So from that perspective, from your sales mix, what is the percentage of the sales which you think is the ink, the printing ink related, or like for example, you are putting 4 verticals in your presentation: coatings, plastic, ink, and cosmetics. What is the revenue breakup mix looks like? That's question number 1. Question number 2 is, you have mentioned that you are trying to pass it on the price increase to your customer. But if I look at your revenue, the revenue has not grown significantly in fourth quarter on YOY basis, despite the cost has been going up significantly. So while the margins are under pressure, that is understandable. Why the revenue is not yet, reflecting, what I've been mentioning, that, you are trying to pass it on, because on 1 year basis, it is not even double digit. So is it possible for you to share with us the raw material index that, I understand there are 200 products and might be 10 types of different raw materials and number of SKUs, but it is important for us to understand that what is the raw material index is behaving and what is your sales price index is behaving, because clearly there is a gap, correct? So I will start with these first two questions and then I will follow up with the third question.
So, sir, I think firstly, from a number perspective, year on year, there's been a 15% growth, right? And to your specific question on quarter, I mean, what we've seen is there has been a demand contraction. And secondly, we had to make some decisions in terms of passing on the increases. We lost certain volumes, right, to competition.
So is it 15%? Sorry, I thought it is a 9% income from operation. Is 9%, not 15%.
Sorry, come again?
You said 15% revenue growth. Sorry, I'm not able to reconcile. Slide number 11 talks about, 9% revenue growth and not 15%, correct?
So Nilkant here, our pigment sale is at rupees 2020 crore compared to 1753 crore of the last year. So it is a 15% growth.
Okay. And that 15%, sorry, please continue.
So that's the 15% growth, yeah.
Haji. So I think you are answering in detail, so 15% versus the raw material index would have been?
No, I was answering your question when you said that we've not grown. I'm saying we've grown 15% in terms of sales, right?
Okay.
So that's one question. To your question on the quarter-to-quarter basis, sir, a quarter-to-quarter basis, like I said, there were two factors. One is obviously Q4, we did see a demand contraction. We've lost Russia, we've lost Ukraine. There has been in Europe, there has been subdued demand. So, China has been closed down due to COVID. So we did see a lot of subdued demand. And in addition to that, we took certain decisions in India also that we are saying that we want to pass on the increases, and we gave up some volumes. So that was the Q4 scenario. Now, if we so this was my answer to you.
Okay. And the sales mix, the four verticals you talk about, coating, inks, what is the sales mix right now?
The sales trend, I think I can give you a trend perspective. I think printing ink has been a little subdued, and I mean coatings has been normal, I would say. So and then this other one, plastic was being subdued. Cosmetic is doing well.
And what is the ballpark sales mix would look like?
So from a competitive perspective, we don't give the split of sales.
Okay, let me put it this way. What is the high growth versus low growth sales mix? If you can tell us something on that.
Could you elaborate your question, sir? I didn't understand your question.
The segments which are growing compared to the segments which are witnessing, probably degrowth or maybe the low growth.
Coatings is growing well.
No, I'm talking sales mix perspective. If I'm not asking now segment A, B, C, D. I'm saying if you club the segments which are probably less growing or degrowing compared to the segments which are growing higher, how your sales mix will look like.
As I just mentioned, sir, we are not giving a sales mix segment-wise. So
Okay, fine. My third question was reference to the raw material index. What is the raw material index if you look at on 1 year basis versus your sales price index?
Sir, as we've mentioned, there has been a general raw material cost increase and other manufacturing cost increases. And since we have a large variety of products, 300, 350, it's not possible to index on an overall basis. We do follow internal index for each of the smaller SBUs, right? And that's what we internally adopt to.
So what is the gap right now?
the EBITDA margin reflects, sir, both the gaps in the raw material and the on the manufacturing costs, the logistic costs.
I see. Perfect. Thank you, sir. Wish you all the best.
Thank you. The next question is from the line of Madhav Marda from Fidelity International. Kindly proceed.
Yeah, hi, good morning. Thank you so much for your time once again. I just wanted to get a more sort of elaborate sense on the demand outlook or the current demand conditions that we have in our key export markets and also India. If you could give us a sense in terms of how the demand is on the ground. That's my first question.
Madhav, can you, like I mentioned, sir, on the demand outlook perspective, there are two areas. So there are, if you look at the segments, printing ink, we had seen some subdued demand.
I was asking more geography-wise, like if you could give me a sense for Europe, US, India.
Yeah, I was giving you all. I was giving you both. Then I was coming to second.
Sure.
Right. So from a perspective of sales, if you look at Europe, we are seeing a little bit of a subdued demand currently. Of course, Russia, Ukraine is completely closed out sales. US currently we are okay, but the future, I would say current demand looks good at least for the quarter, etc. There is a fear of recession going forward, and that time would tell us how that reflects on. China has been closed so far, so China sales has we've kind of lost a little bit on China. Otherwise, I think overall we are looking at ensuring that we get some demand going now.
Okay. So end market, I understand, and also secondly, in terms of given we have a new capacity coming up, the expectation is that obviously Sudarshan will be gaining market share, not just in India but globally as well. So could you give us a sense in terms of like any new client wins or how discussions are proceeding there, which could help us ramp these new capacities in the next 1-2 years? Like, are we seeing good traction for that ramp up?
So for all our new products, Capexes, we are seeing a good attraction on demand. We were expecting on some of our existing products the volumes to grow, and that's where we have put these Capexes. That area we are seeing a little bit of a subdued demand.
Okay, got it. All right, thank you.
Thank you. Participants, if you wish to ask a question, kindly press star 1. The next question is from the line of Ankur Periwal from Axis Capital. Kindly proceed.
Thanks, sir. So first question, continuing with the earlier discussion on the global consolidation. Now that more or less things are stable there. Any thoughts you can share on the competitive intensity overall and our positioning? I recollect you mentioning that our product portfolio after the current round of Capex should be largely at par there. But on the competitive positioning, if you can highlight and how they are dealing with the RM inflation, overall.
So I think the number one, if you look at BASF and Sun Chemicals, I think that integration is still in progress with North Steel, and I think that would be a slow process. That's what we understand. The second one, the Heubock SK Capital Clariant, that is in full swing right now, and full swing at from both these areas. We would look at opportunities coming up, probably in a quarter or two, where customers would start customers are engaging with us more, and in a quarter or two, we will see some more new opportunities coming up due to this. You rightly said our product portfolio is very comprehensive, sir, and we are on the new products. We would get a good attraction from that perspective.
Sure, sir. And on the RM inflation side, is there a pricing differential? Maybe we are passing through more and the others are passing through less, or vice versa. Your comments there.
Yes, sir. I think absolutely, sir. I think also if you look at the Indian industry, we've seen some of the basic chemicals rise far more than the global trend, right? Some of the basic. So we are seeing a little bit of more of a cost increase compared to any of the global players, and that's where we have to pass on a little bit of more increase. But we are playing the balancing game and seeing how do we balance margins and volume.
Okay, so if I got you right, you are saying the inflationary trend is slightly higher for us because of RM inflation being sharper for certain basic commodities here in India.
Yes, sir. Absolutely. Yes, you got it right. Yes.
And hence, from a pricing perspective, we may not be as competitive as we speak today.
Yes. Yes.
Okay. And this is largely, a result of the global disruption that we have seen, or there's some specific local issue because of which we are seeing this higher inflation for RM?
So some of the basic chemicals have really shot up in the last 1 year, right, within India. Whether it's caustic chlorine, whether it's, some of your basics like nitric, sulfuric acid, compared to the global levels, we've seen a larger increase in India.
Okay, fair enough. Sir, second question here on the balance sheet side. Now, obviously, given the Capex, so the debt has also increased. Your thoughts on one incremental Capex, because you did allude it towards doing backward integration for selective products. So what are our thoughts on the Capex side, and whether this should be the peak debt or this number will go up?
Sir, our focus is first to commercialize these Capexes, generate cash, and as the debt starts lowering, so this is definitely the peak debt. And on the backward integration type, our technology, we have our pilot plants ready, so we are already looking at how do we be ready for that. So from that perspective, currently we don't envision, at least in this financial year, any additional Capex. Additional Capex for the backward. Okay.
And the nominal Capex for this year will be?
Will be normal 40-50 crores, sir, which has been approved by the board.
Okay. That's helpful. Thank you, sir. Thanks.
Thank you. To ask a question, kindly press star 1. The next question is from the line of Nidhi M. from Mirae Asset. Kindly proceed.
Hello. Yeah, hi. Tanmay this side. So just one clarification. If I look at the segmental numbers on the pigment side, if I look at the EBIT margins, the absolute number has declined on a sequential basis. So if you could just help me understand, in spite, the mix changing towards more of a specialty product, and as you are saying that we have margins decided on an absolute terms. So if you could just help me understand the decline in absolute EBIT, is it due to depreciation primarily, or is there some other reason as well?
Sir, can you please repeat your question?
Yeah, so I was asking on the segmental data that you provide. I was looking at the absolute EBIT in the pigment segment. So there is a decline on a sequential basis. I think I missed the initial part where you were referring to the higher cost, but I think you also alluded that the costs have remained stable on a sequential basis. So just trying to understand where is the contradiction coming from. We have a higher salience of specialty pigments in this quarter, right? So the EBIT number, why was it lower on a sequential basis is what I'm trying to understand.
Hi, Nilkant here. So if you see in terms of the pigment, as we mentioned, the EBITDA is at 13.7%. So if I see the Q3 of this year, FY22 and Q4, so percentage-wise, it is at the same level. And there has been, if I see in terms of the value, there has been a marginal 3 crore drop in terms of the pigment EBITDA. And as we mentioned in our opening commentary also, so it has been a price escalation and price pass-through. However, this inflationary pressure and price escalations are not static. So these are the timing is frequent. So once we finalize the pricing, we have to absorb some part of the cost. However, in the percentage term, we are maintaining the EBITDA.
Sure. And just one clarification on the Capex front. Earlier, we had indicated that out of the 1,500 crores additional revenue that we are targeting, roughly 600 odd crores would be coming from the new products. So the Capex for the new products has entirely been commissioned, or how is it? Some part of it is still pending.
So as indicated in the Capex slide, sir, 210 crores of that is still to be completed.
So that includes the new products, or how is it? I was just trying to get some clarity.
Those are the new products.
Okay.
Hello?
Thanks. Thanks.
Thank you. The next question is from the line of Chetan G from AlfAccurate Advisors. Can you proceed?
Yeah. Hi, sir. Amar this side. Thanks a lot for the opportunity. Sir, one more clarification. As you said that you are seeing a strong demand in the specialty part of the business, whereas non-specialty or classical pigment is seeing some slowdown. So is it like this non-specialty part of the business is largely those ink and plastic business?
It's a combination, sir. I would say the specialty products go across the industries.
Okay. So next year, sir, as you are saying, worst is behind. On the other side, you are also saying that there is a caution because, Russia, you lost some sale in Russia, Ukraine, plus there is some slowdown expected in Europe and US. So how should we see the next year? On one side, you are pretty confident. On the other side, there is a kind of caution. So next year, what kind of volume growth or what kind of growth we should see on a year-over-year basis? Is it like
Ashwini's question on the cash flow perspective and debt, right? What I was referring to is the Capex has got substantially delayed, and that's how the debt cash flow, are on a critical picture. I'm saying here on, that picture is going to be better. On the geopolitical side, sir, it's anyone's guess how it's going to pan out, right?
Correct.
I think so. I would not like to speculate on that area. But what we are saying is some of our fundamentals on the new products is strong, and we should be able to get good attraction. It's a matter of time how this happens. And I think that question in that context was it wasn't a quarter question. It was more, I think Ashwini pointed out a broader 30,000 question. And so that's where I think I was coming from.
And now, given that new product, as you're saying, a lot of new products are launched or on the verge of launch. So your specialty, which is 70% of the overall pigment business, let's say how it should look in 23.
It would be upward trend. There will be a ramp up time. However, on the existing product portfolio also, we've added capacities, right? So that would also grow. But I think the trend in the next 3 years should positively move towards the specialty.
Okay. So let's say in next 3 years, are you saying the specialty would be like 80 to 90% of your portfolio?
I would say yes. It will be towards the positive trend, sir.
And that will percolate also into the margin.
Yes.
Because I believe the specialty margin is at least what? 50% higher than the classic business?
It's higher, sir. So the specialty margin also has a fairly range. So it's much it's better than the commodity, and the business sticks more, right? Once you get into a customer, it's more it sticks more.
Sir, lastly, if any commentary for the next year growth, I know you don't give the guidance, but at least any color from the growth perspective, volume or, anything.
So, I do believe, sir, we've seen the worst part of the year, and I think from here, we do have a positive outlook towards the market. Given even spite of the geopolitical situation, we should be doing better, definitely, than last year.
Okay. Thank you, sir.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to the management for closing comments.
Thank you. Thank you, participants, for your interest in Sudarshan and for joining our earning call. We look forward to continuing our growth journey and delivering value to all our stakeholders. Thank you. Be safe.
Thank you. On behalf of Ambit Capital Private Limited, that concludes this conference. Thank you for joining us. You may now disconnect.